The four verticals of the financial services industry are depositories, specialty finance, fintech and asset management, or FinTam, as the acronym sometimes goes, and then your broker dealers and exchanges. Let's go through each of those. Depositories is your banks and insurance underwriters. Broker dealers and exchanges could be owned by a bank. It can also be independent market makers such as Citadel Securities. Fintech and asset management, those are your asset managers, BlackRock, Fidelity, T. Rowe Price, as well as fintech companies. Financial technology, they provide technological services to the other financial firms. Then there's specialty finance. Specialty finance is anything that does not fall within those other three verticals that I mentioned. So it can be things like real estate investment trusts, business development companies, special purpose acquisition companies, non bank credit card issuers, non bank mortgage lenders, these types of entities. In terms of valuation, some of the verticals of financial services are quite different and they require specialized expertise that those who cover companies in the widget industry normally don't have. Let's start with the most complicated vertical, the depositories, which is the banks and the insurance underwriters. When you're valuing a company and deciding whether it's cheap, expensive, or fairly priced, it's common with a widget company to use an unlevered discounted cash flow model, where the unlevered free cash flows are forecasted, discounted back to the present at the weighted average cost of capital, and you arrive at the enterprise value or the intrinsic enterprise value that way. But let's think about that. Unlevered free cash flow equals EBIT times 1 minus tax rate plus depreciation and amortization minus CapEx minus change in working capital. So let's go through each of those four components of the formula for banks and insurance underwriters. Banks and insurance underwriters earn interest income as part of their top line revenue. So there's no such thing as earnings before interest for a bank or an insurance underwriter. And asking a bank how much it earned before interest is kind of like asking a lemonade stand how much money it made before selling lemonade. It doesn't really make sense. Then there's your depreciation and amortization. Banks and insurance underwriters don't have a lot of CapEx, and so they don't have a lot of property, plant, and equipment. Hence, they don't have much depreciation and amortization. Yes, the insurance underwriters will amortize their deferred policy acquisition costs over time in accordance with the matching principle. And you have to look at each insurer, what part of the industry it's in, and what its approach is to customer acquisition. But as a group, many of them don't have enough amortization to where I would consider that a big driver, and neither would others that cover the financial services space. So depreciation and amortization isn't that big. Then there's the CapEx piece of the formula. CapEx does not represent reinvestment in the banking business or the insurance business. Reinvestment in regulatory capital does. So the idea there is banks and insurance underwriters will have to hold a certain amount of equity against their portfolios of assets, lending assets, as well as in the case of the insurance companies, they'll have their statutory reserves against insurance liabilities. So there's that regulatory capital piece. And then there's working capital, the change in working capital, the final component of the unlevered free cash flow formula. So that doesn't really work well for banks or insurance underwriters. First of all, they don't even really distinguish cleanly on their balance sheet between current and non-current assets, current and non-current liabilities. So it's hard to calculate it even if you wanted to. But even if you could calculate working capital, it's too volatile of a metric to be analytically useful. So banks with cash and cash equivalents and the repo markets and other short-term financings, they have a lot of volatility in in things that would be considered current assets and current liabilities for a widget company. So it's just not analytically useful there. So we know that this idea of unlevered free cash flow can't work for valuing banks and insurance underwriters. So, what are some solutions? One is to build a dividend discount model, forecast the future dividends of the bank or the insurance underwriter as a proxy for levered free cash flow, discount them at the cost of equity because there's no such thing as an unlevered bank or an unlevered insurance underwriter. They all have leverage. So that's one solution. If you use the dividend discount model, you've got several ways that you can model the dividends, and that you need to model them to make sure that the bank or the insurance underwriter does not run out of regulatory capital during the forecast. So one way to do it is back the dividends out of the model. Beginning retained earnings plus net income minus dividends equals ending retained earnings. And these are real numbers, so they can commute. So therefore, dividends that you could back out are going to be equal to beginning retained earnings plus net income minus ending retained earnings. So you back into the dividend that way. That's one way to get at the dividends. Another way is to model the dividends explicitly one by one, the way you might do with a widget company. If you do this, you need to run a capitalization test for the bank or the insurance underwriter at each interval in the explicit forecasting period to ensure that throughout your model, the bank or the insurance underwriter doesn't become insolvent. That's going to be critical, right? Because you have to have a solvent bank that's operating within the regulatory limits placed on it throughout your forecast. So you can do that explicit modeling, but make sure to run that capitalization test. The other thing you can do is you can try to model behavioral assumptions into the dividend forecast, and this is probably the most sophisticated way to model the dividends of the different things I've described so far. So let's just take the case of a commercial bank. You can forecast the bank's target common equity tier one, and you can also forecast the actual common equity tier one that you think it will hit at each interval in the explicit forecasting period. Then you can run if statements to compare those two in your Excel model. So you can say, if the actual regulatory capital measured with common equity tier one is equal to or greater than the target at any given interval, pay the target dividend. If the actual regulatory capital is above the target, you can even pay an excess dividend beyond that. If, on the other hand, if the actual regulatory capital, the actual common equity tier one at any interval in the explicit forecasting period is below target, then you can build in your model, suspend the dividend, and actually have the bank go issue more equity, raise more cash in the equity markets. And that's a very sophisticated and I think a great way to forecast these dividends, because it's the way that management, C-suite executives of these publicly traded banks, it's how they think about their dividend. Some of them have the knowledge I have and have modeled these companies and really thought about their industry. Some are just operators that worked in a bank and worked their way up, but may not always have that modeling skill set. So they just kind of think of the dividend in common sense terms. They have their target of the dividend they'd like to pay, assuming a target regulatory capital level. If they hit their target regulatory capital level measured with common equity tier one, they'll pay that dividend. If they don't, they'll at least partially cut the dividend and go back to the market to raise some equity. So that's your dividend discount model. Another thing you can do to value a bank or an insurance underwriter is value them based on the present value of future levered free cash flows. You need to define levered free cash flow differently than you would for a widget company. For a widget company, levered free cash flow is net income plus depreciation and amortization minus capex minus change in working capital minus those mandatory debt repayments. But for a bank or an insurance underwriter, levered free cash flow is simply net income minus reinvestment in regulatory capital. So you run that and you forecast that out, and again you discount those back at the cost of equity because there's no such thing as an unlevered bank or an unlevered insurance underwriter. The other thing you can do is an excess return model, which is what you'll do for the terminal value anyways. So you value that bank or insurance underwriter based on the present value of future expected excess returns. The formula for that is the forecasted return on equity minus net income growth rate. That's your numerator. And then your denominator is required cost of equity minus net income growth rate. So notice what I just said. Net income growth rate is stripped out from the numerator, and it's also stripped out from the denominator. And that gets me to an important point. I have a saying, buying a bank and buying a bank that's on fire are two different things. Same with insurance underwriters. Buying an insurance underwriter and buying an insurance underwriter that's on fire are two different things. And why is it? It's because of that formula I just gave for the excess return. Because net income it's stripped out in the numerator and the denominator. If the bank or insurance underwriter in question trades above book value, increasing the net income growth rate will help their terminal price to book multiple under that formula. But if they're trading below book value, a bank that's on fire will not be generating the returns it needs to compensate the investors for the risk they're taking, so it'll trade below book value. If that bank or insurance underwriter trades below book value, increasing the net income growth rate will actually push the price to book multiple even lower. And that's why they're two different things. Buying one that's on fire, you need a management team that's actually looking to reduce exposure, cut costs, reduce risk. That will unlock value. On the other hand, a bank that's trading at a premium to book value has the opportunity and the luxury of playing offense, so to speak, figuring out ways to increase the net income growth rate without increasing riskiness, which will then push the price to book multiple even higher. The other thing on depositories is this idea of enterprise value. Enterprise value equals operating assets minus operating liabilities. It's often talked about and calculated in terms of the way it's financed. So market capitalization plus debt minus excess cash plus preferred stock plus non-controlling interest plus legacy obligations like environmental liabilities and pension liabilities. Well, if you calculate the enterprise value for a commercial bank or an insurance underwriter, you often get a negative number because their excess cash will actually exceed their market cap to the point where the number is negative. So enterprise value is a meaningless concept because there's no unlevered bank or insurance underwriter. And if you did the calculation, you'd get a negative number anyways, most likely. So there's no weighted average cost of capital, no enterprise value. The focus is on cost of equity and then on levered multiples such as price to earnings, price to book, price to tangible book value. Those are three metrics that matter. So that's your depositories and how you value them. They're balance sheet businesses. The balance sheet drives the income statement rather than the income statement driving the balance sheet the way it does with a widget company. So let's move on to specialty finance. Specialty finance, there's different companies within that. So there's going to be different valuation methods that you'll use. Let's look at the real estate investment trust, for example. There's different types of real estate investment trusts, or REITs as they're called. There's equity REITs, mortgage REITs, hybrid REITs. The equity REITs can often be valued with an unlevered discounted cash flow model, whereas the mortgage REITs are valued like commercial banks. So you build more of that dividend discount model. An important consideration for all real estate investment trusts, whether an equity REIT, a hybrid REIT, or a mortgage REIT, all of them under US law, the US ones, must pay out 90% or more of their net income in the form of a dividend. Because of that, they're always short on cash. So they go to the debt and equity markets to raise cash. This happens year round. So when you're valuing a real estate investment trust or a business development company, because they have that payout requirement too, you have to forecast the present value of future dilution costs and build that into your model. And you got to try to buy shares below the present value, their future cash flows. Plus, it's also got to account for the present value of future dilution costs. The business development companies tend to use a fair amount of leverage, although their leverage is capped under the Investment Company Act of 1940. But they have interest income in the top line too, just the way the depositories did. So again, the dividend discount model is going to be helpful when looking at a business development company. You can't really separate operational and financial leverage for those. Those are a few examples in the specialty finance space. And they tend to get into situations where they run out of cash and then they have to raise equity or debt at disadvantageous terms out of desperation to avoid a bankruptcy, or they have to sell off some assets to get cash. Either way, it could dilute the equity value. That's a risk, but it's also an opportunity if you can buy a distressed shares issued by a distressed REIT at prices that are below their intrinsic value. And you got to do the modeling work to figure that out. Then there's these fintech and asset management businesses, FinTam. So with those, those are a lot like the widget companies. You can value those with an unlevered discounted cash flow analysis. So you do the weighted average cost of capital, take the yield to worst of any debt outstanding, which is the lowest of the yield to maturity, the yield to all possible call dates, or the yield to all possible put dates, the minimum of those three yields, times 1 minus tax rate, since interest is tax deductible in the US. So that's your after-tax cost of debt. Cost of equity is often calculated for a widget company with the capital asset pricing model. So the idea there is that the cost of equity should be the risk-free rate plus the product of the market risk premium and the levered beta of the security. Risk-free rate, typically for a long-term investment, you'll use the yield to maturity of the 10-year treasury bond as a proxy for your risk-free rate. Market risk premium, there's different ways to do a forward-looking market risk premium. Aswath Damodaran's forward-looking market risk premium concept is, I think, a good one. So he looks at all the major shops on Wall Street, equity research desks, Goldman, JP Morgan, Bank of America, Lazard, Jefferies, those guys, right? And he takes their average of their spot price expectations for the underlying index in question for the next 5 years. So he looks at all their 5-year price forecast for that. Let's say it's the Standard & Poor's 500, which would be a good benchmark to use if you're valuing, let's say, a large cap US asset manager or a large cap US fintech company that's in the S&P. So he has that. He takes the average of their forecasts and then he discounts it back to the present at an unlevered internal rate of return that makes makes the spot price of the S&P 500 today equal to the average of the forecasts made by those different research shops, and the discount rate that makes those two equal is an internal rate of return that he uses for the forward-looking market risk premium. So that's a good way to calculate it. Then there's the levered beta. So what you do is you find 5 comparable companies that have similar operational leverage, location, same industry, similar size and profitability. They don't need to have similar financial leverage because you can lever and de-lever the betas with the Modigliani Miller. So that formula is levered beta divided by 1 plus the product between the firm's net debt to equity ratio and 1 minus its tax rate equals unlevered beta. Once you have the unlevered beta for the 5 comparable companies, you take the average of those and re-lever it at your target firm's capital stack. So it's net debt to equity ratio. And that's how you would get the cost of equity. And then once you have the cost of equity and debt and the 1 minus tax rate, which you strip out of the debt piece of it, then you just do your weight of debt times cost of after-tax debt plus weight of common equity times cost of common equity. And if there's any preferred equity, you add that in too. That's how you get to the weighted average cost of capital. For the depositories like the banks and insurance underwriters, you can't do that because you can't lever and de-lever the betas, since you can't separate operational leverage from financial leverage. So you typically run a Monte Carlo model. Find comparables based on the Camel's approach: capital adequacy, asset quality, management quality, earnings quality, liquidity, and solvency, also sometimes called surplus capital. That's your Camel's approach. And once you've found 5 comparables, you use random numeric sampling to look at their historical price moves and use that to forecast and get an idea of what the average cost of equity might be. So that's the first 3 verticals. Then there's the fintech and asset management, which we covered. There's also broker dealers and exchanges. Those can typically be valued with enterprise value to revenue as well as an unlevered DCF. So pretty similar to the fintech companies most of the time. So this is just a high-level overview of the financial services industry and some of the companies I cover, some of the mechanics you need to think about when valuing these. Hopefully you learned something from this. Please leave a comment below. I'd love to hear your thoughts about the industry, anything I didn't add, anything you agree with, disagree with. Leave a like, share this with friends and family, and leave a comment below. Thank you.